For years, mid-cap U.S. companies lived in a kind of market blind spot. They were too big to be exciting startups and too small to command the constant attention given to market-dominating giants. Investor narratives revolved around mega-cap safety on one side and small-cap breakout potential on the other. Mid-caps were often treated as a transitional category rather than a destination. That perception is now changing. Mid-cap U.S. companies are attracting more investor attention than they have in years, and the reasons behind this shift say a lot about how investing priorities are evolving. One of the most important reasons is changing risk tolerance. After repeated periods of market volatility, investors have become more selective about where they take risk. Small-cap companies often rely on optimistic growth assumptions, external financing, or unproven business models. Mega-cap companies, while stable, face slowing growth due to their sheer size. Mid-cap companies sit in between. They usually have established operations, diversified revenue streams, and proven demand, while still offering meaningful room to expand. This balance of stability and opportunity is increasingly attractive in a cautious market environment. Valuation dynamics have also pushed investors toward mid-caps. Many large-cap stocks trade at premium valuations built on high expectations for future performance. When growth slows even slightly, those valuations become vulnerable. Mid-cap companies, by contrast, are often priced more conservatively. Investors see greater potential for multiple expansion if these companies execute well. In a market where upside feels harder to find, mid-caps offer a valuation starting point that feels more forgiving. Another key factor is operational leverage. Mid-cap companies are often at a stage where incremental improvements can significantly impact profitability. They are large enough to benefit from scale efficiencies, but not so complex that change is slow or expensive. Investments in automation, supply chain optimization, or pricing discipline can quickly translate into margin improvement. Investors recognize that these internal levers can drive returns even if overall economic growth remains modest. Strategic flexibility is another advantage drawing investor attention. Mid-cap companies can adapt faster than large organizations burdened by layers of management and global complexity. They can enter adjacent markets, refine product offerings, or pivot strategy without disrupting massive legacy structures. In an environment defined by rapid shifts in technology, regulation, and consumer behavior, that flexibility is valuable. Investors increasingly view adaptability as a competitive edge rather than a soft attribute. Capital discipline has become a central theme in U.S. markets, and mid-cap companies often align well with this priority. Many have moved past the phase of aggressive, cash-burning expansion. Instead, they focus on generating predictable cash flow, funding growth internally, and improving returns on invested capital. This discipline resonates with investors who are prioritizing durability over speed. Mid-cap firms that can grow steadily without relying heavily on debt or equity issuance stand out in today's market. Mid-cap companies are also benefiting from acquisition dynamics. Large corporations facing slower organic growth increasingly look to mid-cap firms for strategic acquisitions. These companies often possess specialized technologies, strong customer relationships, or niche market leadership. Even when acquisitions do not materialize, the possibility influences investor perception. Businesses that are strategically valuable tend to operate with clearer focus and stronger fundamentals, which supports long-term performance. Sector exposure further enhances mid-cap appeal. Many mid-cap U.S. companies operate in industries that are essential but not flashy. Industrial services, healthcare providers, logistics firms, infrastructure-related businesses, and specialized manufacturers make up a large portion of the mid-cap universe. These sectors benefit from long-term demand drivers rather than short-term trends. In uncertain markets, investors are gravitating toward businesses tied to structural needs instead of discretionary cycles. Analyst coverage patterns also play a role. Mid-cap companies are typically less covered than large-cap stocks. This creates inefficiencies in pricing and information flow. For active investors, this represents opportunity. Thorough research can uncover mispriced assets with strong fundamentals. As more institutions allocate resources toward mid-cap analysis, increased coverage itself can act as a catalyst for greater investor interest and liquidity. Another important consideration is concentration risk. Many U.S. equity portfolios have become heavily weighted toward a small number of mega-cap names. This concentration increases vulnerability to sector-specific shocks, regulation, or earnings disappointments. Allocating more capital to mid-cap companies helps diversify exposure while maintaining growth potential. Portfolio managers are increasingly using mid-caps to balance risk without sacrificing returns. Mid-cap companies also tend to face less regulatory and political scrutiny than the largest corporations. Mega-cap firms often operate under intense oversight related to competition, data privacy, labor practices, and national security. Mid-cap firms generally operate below that threshold, allowing management to focus more on execution than compliance complexity. Investors see this as a quieter but meaningful advantage. Importantly, the renewed attention on mid-caps is not driven by hype. It reflects a broader shift toward realism in investing. Investors are recalibrating expectations, favoring companies that can execute consistently, generate cash, and grow responsibly. Mid-cap companies often exemplify this mindset. They are ambitious but grounded, scalable but controlled. This does not mean mid-cap investing is without risk. These companies are still exposed to economic cycles, competitive pressure, and execution challenges. What has changed is how those risks are evaluated. Compared to speculative growth plays or fully mature giants, mid-cap companies now appear well-positioned for the current phase of the market. The growing focus on mid-cap U.S. companies signals a move away from extremes. Investors are no longer chasing size for safety or novelty for growth alone. They are looking for balance, adaptability, and sustainable performance. Mid-cap companies sit at the center of that shift. That is why mid-cap U.S. companies are attracting more investor attention today. Not because they are suddenly new, but because the market has changed its definition of what makes a company truly investable.